Alright, we'll go ahead and get started. Anybody, before I jump into Chapter 11, have any substantive... Did y'all rearrange the tables in here?
No.
I don't remember how it was before now. It was single tables, right?
Yeah, there were single lanes, and then these were all middle.
You guys can switch it back if you want. I guess the people on that side don't really care, but we've got the people that are not screwed by this arrangement. Are you guys good? You guys good back there? Okay.
All I know is that it was like this when we came into class at noon on Monday.
I know they switched it around, but all right, we'll keep it like this if it doesn't bother y'all too badly. All right, so chapter 9 or 10, any substantive content-related questions before I move into the new stuff? Okay. All right. Today we're going to talk about we're going to talk about liabilities in general, and then we'll talk more specifically about current liabilities and payroll accounting. Okay? All right, what is a liability? Before accounting class, what did you guys say a liability was? Most people think, oh, I owe something, right? And typically that's not a horrible definition to define a liability. The textbook, more accurate definition of liability has past, present, and future components to it that are all required to be considered a liability. So this basically means whatever was required to ensure that this liability is in place. So like if it required a signing of a legal document or receiving money from someone who's loaning you money, whatever it was, something happened that has already happened in the past that has created an obligation for you now. In other words, today, whenever you're talking about this, anything you call a liability today to you means, hey, as of today, I owe something in the future, some type of value to someone in the future based on something that already happened in the past. Okay? So that's the general broad definition of a liability. Now, when we talk about, in terms of financial statements, obviously anything related to liabilities is captured on the balance sheet and generally divided between these two categories, current and long-term liabilities. And as with pretty much everything related to accounting, when we talk about current versus long-term anything in accounting, that generally means, in most cases, it means within the year it will be gone, essentially. So in the case of a liability, it would mean in the time span of a year from the date that whatever balance sheet you're looking at was made. From a year from that point forward, we expect to no longer be owing this money to someone. So that's two components to that. A, we expect the liability to be off our books within the next year, but that also means that within the next year we're going to have to spend cash or some type of other asset in order to make that happen. And then, of course, long-term liabilities would be anything outside the year. I wouldn't even, at this point in your accounting careers, I wouldn't even worry about the terminology operating cycle, because it's so rare that any business has an operating cycle that's longer than a year. It does happen, but most of you all will probably never be in a business like that, and or certainly not be doing accounting for a business like that. So just think current versus long-term in accounting pretty much all the time. Is it meet that 1 year rule? Is it going to be gone within the next year? When we talk about liabilities, there's kind of three different components of the liability where uncertainty can arise. Obviously, in accounting, we dislike uncertainty greatly because the whole idea behind the accounting profession is to, as accurately as possible, record the historical, in terms of financial accounting anyway, record the history of the company in financial terms. Obviously, if you're dealing with the history, the more accurate the history, the better it looks and the more useful it is. Anytime you have uncertainty, that means even if you do everything right in recording it, it could end up being wrong just by its very nature. Okay? So there could be an uncertainty with who you have to pay. That might arise, for instance, if you're talking about a company who is reporting a liability for warranties. Okay? So if they have some type of warranty guarantee that they're saying, hey, if your product breaks within the next 3 years, send it back to us. We will fix it or provide a new one. Obviously, if you send back products to a company and they have to either fix or provide a new one, that costs them money. So following the matching principle of accounting, if I incur the obligation to pay someone in the future and that arises out of revenue I earn today, I'm going to also need to record that estimate today, right? But I might not know, obviously, if I'm recording a warranty estimate ahead of time, I obviously, even if I know all my customers' names, I obviously don't know which of my products are going to fail, and also which of the failed products are going to be sent back to us for warranty service. But you also, obviously, in that same scenario, wouldn't know necessarily when that was coming. And then you also have scenarios where you don't know how much you may end up being liable for. A scenario like that, again, same one basically. If you look at warranty expense or warranty liabilities, you don't really know you can guess how many of your products are going to break. But like I said, even if you know exactly, you are very, excuse me, you are very scientific in your what is that? Internal control, yeah. Did you have a comment? Uncertainty. Yeah, that's basically the whole actuarial profession. If anyone has looked at that, the career of being an actuary is going out and basically using math to give accurate guesses on that stuff. So for a lot of these uncertain liabilities, and this is kind of beyond the scope of this class, but in accounting as well, we will use actuaries a lot for that very same purpose. We say, hey, go out and based on, a lot of times this will happen in terms of like retirement benefits. You have no idea when someone's going to retire. You don't know how long they're going to live after they retire. A lot of factors go into that. So yeah, pretty much every company that does financial statements is either hiring personally or kind of subcontracting actuaries to give some certainty to some of the uncertainties that arise. But we'll cover a bunch of different scenarios that talk about different levels of uncertainty. But actually, the final slide in this slideshow will give a little rundown of how do you know when and how to record a transaction. Basically, how do I know if I have enough information to record it in the financial statements? But first we'll start with some known liabilities. These are types of liabilities where those three unknown possibilities that we just talked about, who we're paying, when we're paying, how much we're paying, are non-existent. These are all perfectly laid out for us. Okay, so these items in the blocks are just I guess down here we've got some categories that might not be specific account names, but until you get to these bottom two, these are all account names, specific titles that you see in most entities for some more common known liabilities. Accounts payable, hey, this is just our generic catch-all for money that we owe to other entities. Sales taxes payable, obviously, if you're required to collect sales tax, then you will eventually have to give that to the government, which means you owe it to them as soon as it happens. Unearned revenues we've touched upon. This is basically where someone gives you money before you do the work, so you are now liable for that amount of work. So that's a liability. Notes payable. we call that, and we're real specific here with short-term notes payable, just because oftentimes notes payable are extending out beyond that 1 year mark. So this is just basically keeping that as a current liability. And then we have some various types of payroll liabilities and other multi-period known liabilities. Okay, so here's an example of a journal entry for sales tax payable. So this is obviously Home Depot. Home Depot is a retailer, so they make a sale, and they collect not only the cost of the sale, but they also collect some sales tax. So if the item costs $6,000 in this case, we collected in addition 5% in sales tax. So the actual amount of cash we collect is the sale plus the tax. And so that money we collected as a tax, rightly, is shown on our balance sheet as a liability, because is that our money? No. Uncle Sam certainly doesn't think so, or the Commonwealth of Virginia, or whatever entity you're collecting for. Right? So you're basically just holding that for them. Right? You're holding on to it for the government until such a time as you decide to pay them, which generally just means, hey, you may have a cycle where you're paying these types of things once a month, or however you have it set up. Most of the time, these are direct deposits now, but you basically will have however much sales tax you collect in the time period. We'll just collect in this account, sales tax payable, and then obviously at some point you would take and eliminate everything in that account, sales tax payable. So, obviously when the time comes, and I'm sure we'll touch on this more in a minute here, but when the time comes to pay Uncle Sam or whoever you're collecting this for, then you would have a debit to whatever your payable was, in this case sales tax payable, and a credit to cash. Okay? So what you'll notice is, regardless of the different rules or scenarios associated with these different liabilities, they pretty much all follow this same format in terms of recording the existence of the liability with some type of credit to a payable account, or obviously in the case of unearned revenue, it would be the unearned revenue account. But apart from that one, they pretty much always have a payable in the name. So we have a credit to that payable, and then a debit that basically shows what we got in exchange for this liability. Okay? Bottom line is, to incur a liability, you will credit some payable account generally, and to get rid of the liability, you will debit that same payable account whenever you pay off the debt. Okay? And regardless, you'll see as we work through these, they all pretty much function that way. Okay, so here we've got Rihanna selling $5 million in ticket revenue before she performed, right? So at the point when you buy those tickets, all the way up until the time, the moment that she sings, that is unearned ticket revenue, right? Because what is she selling tickets for? The concert. So until the concert happens, she has not fulfilled her end of the deal. Then, after one of these 8 concerts happens, all of the ticket revenue associated with that concert, one of 8 here, goes from our payable account. I know it doesn't have payable in the name, but this is one of the only ones that doesn't, so still think of that as a payable or a liability account. So it goes credit to incur the liability, debit to that same account to close it out. Same as the last one we talked about. Like I said, just a brief definition of the short-term note payable. But again, what at the outset here, what this is, I guess I should read what this particular scenario is asking for. August 23rd, Brady Company, okay, asks McGraw to accept $500 or $100 cash and a 60-day 12% $500 note to replace its existing $600 account payable. So in English, that means, hey, this Brady Company probably got some type of business-to-business transaction with McGraw, and McGraw fulfilled their end of the deal and billed Brady for the full amount, right? Well, apparently Brady didn't have, or whatever the scenario, the money to pay all of that within, typically that's going to be a 30 or 60-day turnaround for accounts payable. So instead, Brady comes back and says, hey, instead of the full amount by the due date, I can give you $100 now, and then would you be okay with doing the other $500 in this note payable? And again, a note payable is just kind of a more formal, usually written, binding legal agreement than an account payable. And it usually has stated interest terms associated with it. So this usually happens in situations where, like this, where for whatever reason the company or individual cannot pay the original terms of the account payable, and so they say, hey, let's make this a more formal arrangement, extend out the length of time I have to pay, and I will also pay some interest in addition to that. So with the journal entry, all you're seeing happen here is the initial account payable, which we didn't record, it was just already out there, was this $600, okay? So what's happening here with that debit, we're just getting rid of the accounts payable associated with McGraw, okay? So we no longer owe McGraw an account payable at all. And we paid that off by giving them $100 cash, so our cash went down by $100. And then we also incurred another $500 liability. So we got rid of a $600 liability, we got rid of some cash, and we incurred another $500 liability. Okay? The fact that that $500 liability under notes payable has these interest terms associated with that doesn't come into play until that interest becomes an issue. And obviously interest does not start getting owed until time passes. So at the moment that this happens, this is what the journal entry is to show it. Okay, so then that, whoop, too far. Come on. There we go. All right, so this is the other side of that. When time passes, so interest gets incurred, but we come back and we pay off this loan. Okay, so if you look at the time between when we incurred the note payable and paid it, that was 60 days. Okay, why is that important? Because the interest rate is always, or pretty much always, unless stated otherwise, stated as an annual rate. So if you calculate 12% times the $500, that only tells you what you would owe in interest if we weren't paying for a full year. Okay? So instead of that, again, I think I brought this up the other day. When we're talking about years in accounting, they round the day numbers to 360 so that it's just 12 30-day months. Really nice and round. Okay? So we're basically saying 1/6, okay, of the year has passed here. 60 out of 160, or out of 360 is 1/6. So we take the $500 that we borrowed as a note payable, we multiply that times the yearly rate, and then we multiply whatever answer we got there by 1/6, or 60 divided by 360. Okay? That tells us what amount of interest we incurred during those 60 days, 12% annual interest rate. And so our final closing journal entry here for this transaction, we've got that $500 there, which again just eliminates the note payable from our books. The $10 in interest expense that we calculated, we will recognize that here. Remember, recognizing interest just means you have a journal entry that has, recognizing expense just means you have a journal entry typically that has the word expense in one of the accounts, and that account is telling you how much expense you're recognizing. From McGraw's side. Okay. At that point when you received it, so what would the journal entry look like? So on the company side, an account payable would be what on, if account payable on one side is what to the other side? Receivable, right? So you would eliminate the account payable like we did in the last transaction, and turn it into a note and turn it into a note payable the same way that they did there, right? The only difference would be obviously payables payables and receivables basically swap. Okay. All right. Anybody else have any questions on this one? Any time the liabilities have interest associated with them, this is the format that you will see for any such cases. And again, I promise people will miss questions. I saw a number of questions already missed on quizzes that we've had so far based on not looking at how much of the year they're asking you about. If you calculate annual interest when they ask you about several months worth of interest, you will get the question wrong. Okay. So another scenario here, September 30th, company borrows $2,000 from a bank at 12% interest for 60 days. Again, the beginning portion of that, like I said, has a credit to a payable account showing that we are incurring a liability. And in this case, what did we get to that? Well, we got some cash. What did we debit to that asset account? Okay? So again, the fact that there's interest associated with this is not interesting to me, no pun intended, for that first journal entry, right? Because no time has passed as of right here. This is the moment that this debt is being incurred. As of 5 seconds later, theoretically, interest has started to build up, okay? So November 29th, which again is 60 days later, we're going to go ahead and pay this off. So we have the $2,000 note payable going away with that debit. We've calculated the $40 of interest based on this equation here. Again, paying close attention to the amount of the year that we're talking about. And then obviously the amount of cash that we are required to pay in order to make the debits in that transaction happen would be $2,040. Everybody's with me still? Okay. Okay. We talked a little bit about some adjusting entries in the past. And so I don't remember how many of these specific types we looked at. I know we probably at least saw a couple. But this is an instance where adjusting entries are often required. Is if you have a note payable that it straddles two periods, which would be very frequent, right? Even a short-term note payable, unless you incurred it right at the beginning of the year, it's very likely that it's going to straddle, the payoff is going to straddle into the next year. That means that there will come a time, in this case, the end of the period, as shown here in this little chart, where we will have to say, okay, we haven't paid off this note yet, but since the moment that I, what it's calling the note date, the moment that I signed this note payable, until the end of the period, that much time has passed, and during that time, I have incurred interest expense. Meaning, time has passed, so I will owe interest on this based on the time that's already passed, and because of the matching principle, the fact that I incurred that expense during this current year theoretically means that whatever I got the note for, that cash, whatever, the benefit that helped me, or at least some of the benefit from that helped me earn revenue happened this year. So I need to make sure that at the end of the period, there is some expense recognized associated with the assets that I got from this note. I know that's a little bit confusing, but basically you can just think about it like I want to make sure for most expenses that as they're incurred, they show up on the financial statements. Most of the time that will take care of knowing when to say when on the expenses. So for this scenario, you can think, hey, if I took out this note, in other words, I took out a loan in, say, October 1st, and it's now December 31st, for the end of the period, it makes sense that during those months of time passing, there is some expense building up. And so therefore, since the expense was incurred, I need to, at the very least, check to see if it should go on the financial statements. And in the case of interest, it definitely should. So what does that look like? So we're changing the dates here, I think. Yeah. We're changing the dates around a little bit so that we pick the note out December 15th. And let's see. This slide is totally messed up. We've apparently only changed the dates in the description and not on the actual journal entry. So looks like that December 16th should go where you see that September 30th right there, and February 14th goes here. So that will just continue this. But basically, you can see that we don't pay the interest until next. If you're looking at this date, we're not going to pay that until 2014. But at the end of, man, these dates are all messed up. They need to freaking fire their editor at McGraw-Hill. Okay, so this 2014 down here should be a 2016. I'm not going back in time here. So we got December 16th, 2015 here, and then basically the next February is what that should read right here. Okay? So if you look at those dates and you think about they were intending with this, basically between December 16th and the following February 14th, the end of the year happens, right? So during that time period, December 16th to December 31st, you've got 15 days, or basically half a month. So on our end of December, whoops, I guess it doesn't even show us that. Let me write what that would look like here. All right, so the adjustment would look like this. First, we want to figure out how much is half a month of interest. Okay, so someone with a calculator, do the math. 2,000 times 12%, so 2,000 times 0.12, and then divide that amount by 24. It's 10? Okay. So $10 is the amount of interest that I would actually recognize 10 of this 40 right here. I would recognize as of December 31st. Okay, so what would that look like? The debit to interest expense and the credit to interest payable. Okay, so in this scenario, we're saying, okay, ignoring the horrible dates that they have in the slide, we're pretending that the dates were December 16th, that we incurred this, and then whatever 60 days later was in February, we paid it off. So 15 days after we incur it, the end of the year happens, and so between December 16th and the end of the year, we have incurred $10 worth of interest expense. Remember, as time passes, that clock starts to tick, and interest expense just slowly builds as time passes, right? What's that? Oh, 24. So that was, since we figured half a month, dividing by 1 year's worth by 12 would give us 1 month. Dividing by 24 would give us half a month. So I skipped the step that I did in my head. So yeah, divided by 24, just based on, the easy way to do that would just be total number of days divided by 360. Easy way of doing it. All right. Again, the end of period adjustments are probably a little bit beyond the scope of what I would actually ask you to do in the class. But just remember that when you're talking about interest, as time goes by, you're going to continually incur expense. So you're pretty much, if you have anything that has interest tied to it, you will have adjusting entries, or your business will, related to interest. All right, so let's move into payroll liabilities. Anyone who has had a job of any kind, assuming it's not been just paid out under the table in cash, is certainly probably familiar with the fact that you may get, your gross pay may be number of hours worked times your hourly rate, but that is not what you actually get to take home. Because your employer takes out a bunch of things that they automatically withhold from your paycheck in order to give it to someone else. Okay? Similar to the sales tax example, most employers who are going to, at least who have a bona fide employer-employee relationship, where we're talking they're issuing you W-2 versus the 1099. But anyway, in those scenarios, they're going to withhold a bunch of your money. So you're going to get a net pay here that goes into your wallet will be less than, and considerably very much less than, what you actually made in salary or hours times hours worked. Okay. What that means for your employer, so from the business side, which is whose lens we're looking through here, they have all these other liabilities that they are incurring when they withhold money from your paycheck to give to a third party. Okay? So we have all of these employee related payroll deductions that cause us as an employer to incur these liabilities. But it's not like we're actually paying this money with company money. I guess theoretically we are, but it's money that we had already promised to pay someone else, and we're just basically redirecting someone's salary into a holding spot for us to then give it to the government. Okay. I don't really care that you know the rates associated with this. If you take an income tax class, you'll know that, or look at it very regularly. But that's the amount that your employers are going to pull out and hold. For all of these, it doesn't really matter to me necessarily what the amounts are. any questions, most of the time, at least for principles of accounting, I'm not going to ask you to calculate the tax. I'm not going to ask you to calculate a lot of this stuff. They'll just say, hey, you had X, Y, and Z that you had to withhold, not you had X amount of employees. Tell us how much to withhold. Okay, so let's see here. For all of these all function pretty much the same here. State and local federal income tax that gets pulled out sits in that just holding spot, ready to pay to the government. If you have like what is that, AFLAC? If you have AFLAC or some other voluntary, that would be a voluntary deduction where, or I guess any of your insurance, most of the time, the employer, at least like for FU, for instance, they offer us 3 different types of insurance packages, and we're able to choose between those or decide we want to opt out altogether. So situations like that where the employee actually controls either how much or whether at all they want to pay this money, that's still, if it's handled on the employer side, in other words, if they're the ones withholding it, then we're concerned about that in the same way, because the employer agreeing to withhold that money for you is basically saying, hey, I will incur the liability, and then I will pay the third-party recipient, for instance, an insurance company or whoever else this may be, for you. And so this generally is just a way to be a little bit more efficient for employees and employers both. But from the employer side is handled the same way we talk about taxes and various other types of payroll expenses. So this is a typical journal entry to recognize these things, and what you'll notice here is that we've got a debit to the expense that we're talking about. In this case, salaries expenses, where we capture all of these. So we've got a debit to salaries expense, which shows the total amount that we're paying in salaries to employees. Okay, of that amount, some of it will be down here, which ends up being the actual amount that's going on the checks. Okay, but the rest of these would be incurred on behalf of employees, and so we've got these liabilities sitting there until whatever time we have set up to pay those to whichever entities we've incurred them from. Then we also have some expenses that we pay not. So this part gets a little bit confusing for people, because the slide that I just showed you, or I guess let me say it this way. Your employer will end up creating, because of you working for them, will end up incurring liabilities to for FICA taxes, both I guess in 2 different ways, both on your behalf and as an entity itself. So not only is an employer required a lot of time to just act as a middleman for your portion of FICA and Medicare and unemployment, they also have, in addition to that, their portion of it that they're supposed to pay. It gets a little confusing because ultimately they're paying both portions, right? But the portion that they pay on the behalf of the employee is actually coming out of the gross pay of that employee. Okay? Just because that gross pay ultimately comes from the company itself too, that's what kind of can confuse the process here. But you'll see, as far as the journal entry goes, and again, I don't really care that you know how employers calculate that. That's more of a tax question. But you'll see from the journal entry standpoint, these don't look a whole lot different, right? Now instead of salaries expense, we're capturing all of these within the payroll taxes expense account. Okay? So logically, if you think about that, it makes sense that within the salaries expense account, we capture all of the not only net checks that we paid out, but also all of the money that we paid or withheld on behalf of employees to pay to the government. Okay? So now this one, payroll taxes expenses, or it could be called a number of things, but this particular segregation of it shows us the portions that we're paying for ourselves or on our own behalf. These are not items that we are incurring the liability of because of, I don't want to muddy that water any more than it already is. For the purposes of this class, you don't really need to know why these are separate other than just basically knowing that on the payroll tax expense side, you'll have one journal entry that captures all of these 4 components, and that will pretty much be all that you would see on that for any company. And then on the other side, everything that comes out of the person's paycheck is captured under the salaries expense journal entry. But they all look like this, right? They are all debit to some expense account, credit to a bunch of payable accounts, which basically means debit to an expense account, credit to all of these liability accounts. But real quick before I move on, again, just like any liability account, this is the journal entry that incurs the liability or shows it going onto our books. And then later on down the road, we will eventually pay this off. And when we go to pay this off, all of these become my debits. And then I would just have a credit to cash for a total amount. Okay? And that's how all liabilities function. You have a credit that captures the initial liability when it's incurred, and then to reverse out those liabilities when we pay them, we'll have a debit to each one of those accounts for that same amount, and then a credit to cash for the sum total. All right. We also have scenarios where we're talking about, up until now, those were all known liabilities. This is throwing a little bit more of a wrinkle in there where we have a known obligation. We don't know the exact amount, but we say, this is kind of a key buzzword, that it's reasonably estimated. In other words, there's a reasonable way to go about estimating. Okay? So again, this would be, just like I was saying to D'Angelo earlier, this is an exact typical scenario when we're talking about these payroll situations where we will run into a lot of need for accurate estimates and probably employ the services of an actuary. But anyway, the unknown portion of this is not all that important for this class other than to know what to do with it. In other words, for principles of accounting, we're never going to tell you, go figure out how to give me a best estimate at what this uncertain liability is. In this class, and in most accounting classes all the way up, they will give you the amounts, and you will just need to know, hey, $20,000 goes into employee benefits expense, and if they've given me these two numbers, 8,000 and 10% of 120,000, to go into those two categories as well. But yeah, I would say pension benefits would probably be the number one group of liabilities. where you're almost always dealing with some uncertainty. Warranties would also be a very significant category of this. Again, for the purposes of this class, pretty much always you're not going to be asked to figure out a way to estimate these things. You're going to be given an amount and told, okay, we've said we're going to estimate there's going to be $640 worth of liability expense here. So if you're given that information, can you plug it into this journal entry? So again, just like the other ones we've talked about, you've got a debit to an expense account, and you've got a credit to a liability. And in this case, what that basically means is, hey, we've already recognized this full amount of expense, and then that gives us a cushion for, let's say the next, however long, during which time we don't have to recognize any more warranty expense when warranties actually come in, right? Because all we're doing, now that we've made this estimate ahead of time, which we did because of the matching principle, until we use up all of this estimated warranty liability, which we use it up as these warranties come in, okay? So as a warranty comes in, we incur a money obligation for it, or we get rid of some parts, and the warranty liability goes down, and obviously the parts or whatever asset we use to settle this is also going down. We incurred the liability with the credit, right? So that was, this one right here. So for the ones where we're estimating, we are recognizing that full amount of expense, even though obviously it's an estimate, right? So we're recognizing, okay, we assume of this car, the $16,000 car, we assume that in the next year or 12,000 miles, the terms of the warranty, we assume that $640 worth of that, or $640 will be needed to cover that expense, right? And then obviously, that doesn't necessarily mean that you will get $640 in expense. In reality, this might be the only claim on the warranty, or you might get $3,000 on the warranty, or most of these cars will have some type of powertrain warranty. So what if the engine dies? And all of a sudden you've got $8,000 or $10,000, depending on the car, dollar cost that goes on your inventory. So obviously, figuring out how much to estimate, that's a whole different ballgame. But once we figure out how much to estimate, then we record that amount immediately and expense it immediately to follow the matching principle. And then as time passes, we slowly chip away at that estimate until such a time as it's expired. And then obviously, and this is beyond the scope of this class, but once it expires, anything that you have left in the estimate category would obviously come out of that and could go back into your books. Okay? But for this class, just know that like everything else we've looked at, or like many of the categories of liabilities, we're going to debit either to an expense account or to some asset account that shows what we're getting for this liability, and then we will credit to the liability account to show the debt is incurred. And then as the time passes, or as these payments come in, we will lower the liability account with debits and lower either, in that case, inventory or cash. And those are generally going to be the two categories. Okay? So, when do I have to do what in terms of contingent liability? Contingent liability just means I don't know for sure that I'm going to have to pay this. So this flow chart will be the last slide today, and this flow chart gives you your decision making in terms of how do you have to record this. So, okay, I have this liability that I'm not sure that it's going to happen or not, and I have to immediately decide, is it a remote chance it's going to happen, is it possible, like may or may not happen, or is it more likely than not going to happen? Once you make that choice, if it's remote, you don't have to do anything. So if it's pretty unlikely that this is gonna happen, then obviously this is a very gray area. But if it's pretty unlikely that's going to happen, then there's no disclosure required. If it's a fair possibility that this is going to happen, but it's not probable, in other words, not more likely than not, then it just has to go in a note to the financial statements where you say, hey, by the way, this might happen in the future. Then, third category, it's likely to happen. You're likely going to have to pay this. Even then, you only have to record it as a liability if you have a solid estimate as to what the amount's going to be. So if it's like, hey, we know we're going to have to pay money, it's going to be somewhere between $5 and $10 trillion. Okay, that's not very estimable, right? So that would be a disclosure in the notes. Okay, if it's both probable and estimable, in other words, I'm able to estimate it, then I have to actually do the journal entry just as if it was a known liability. Okay? Anybody have any questions on that? Alrighty, I will see y'all on Thursday. Yes, sir.